It's almost noon here in Twin Falls, and I want to welcome you to another edition of the Video CPA. Today we're going to talk about the mortgage insurance premium deduction. And you see I've got whoopee by it. I don't think much of this deduction. It's not a huge deduction. Not too many people get it, but you need to know about it. You might be able to get it, and possibly it will pay for a dinner out or something like that. But let's get going. We'll talk about what it is, who gets to take the deduction, and then who really cares. And some people do care. I shouldn't be so flippant about it, but some people do care. So here's our disclaimer on affiliate marketing and our disclaimer on education. So let's get into it. So let's talk about the mortgage insurance premium, which is referred to as MIP a lot. So when you go, if you've gone and purchased a house, you've probably had to get a mortgage unless you've been able to get it with cash. And if you get a mortgage and you pay less than 20% down, they're going to charge you MIP for it, okay? And what that MIP does is you're paying the premiums, but it's protecting the mortgage company so that if you default, they've got some insurance to protect themselves on that loan. Okay, so if you give a small down payment, really that's what it's for. It's they've got increased risk, they think, and so you get to buy insurance for them to protect them if you default on the loan. And that's what MIP is. And the amount paid in MIP each year, just depends on the size of the loan, but the IRS does allow a deduction for it now. Congress really, in all their benevolent thinking, decided that they would throw us a bone and give us a small deduction. And the good news is it was actually extended from 2020 to 2021. We don't know if it'll be extended again, but hey, why not? Makes people happy, I guess, and it's a small, very small deduction for them. They're not losing a lot of tax money on it, so let's talk about who gets to take it. All right, first of all, you've got to have a mortgage on a qualified residence, and that mortgage has got to be a mortgage that has where you're paying MIP on it, mortgage insurance. So that's the first thing. Second thing is you've got to be able, in order to take this deduction, you've got to be able to itemize your deductions. Now, the deal is on that is that most people do not itemize their deductions anymore. You can see here, if you're a married filer and you've got, you have to have over $25,100 before you itemize your deductions, okay? And single filers, $12,550. That's quite a bit of money. That's a lot of money. So unless you've got a big mortgage and you're paying lots of property tax and maybe you're paying tithing to your church or something, you're not going to get that. And then the other stickler is that if you are able to get it, then you might not meet the income limitations. If you can pay that much in itemized deductions, you may not meet the income limitations that are required to get this deduction. So this is the deal. Married filers over $25,100, head of household $18,800, and married filing separately $12,550. If you don't have itemized deductions over that amount, you take the standard deduction because that's the amount of the standard deduction, okay? And it doesn't pay you to even add up all your medical receipts and stuff like that, which has a 7.5% floor on it anyway. And so unless you've got a lot of medical, you're not going to get anything on the medical line. So not many people get this deduction, and that's why I don't think much of it. But so the phase out is if you make over $100,000 as a married couple, it starts to phase out, and it phases out at $109,000. I was doing a tax return for my daughter and son-in-law recently, and he had taken this. He always prepares his own return to see how close he can come. He's a doctor, and he wants to see how close he can come to getting it right. And one of the things that he did wrong is he took the MIP deduction, and he doesn't do it, software catches that type of thing, but he just kind of does it on hand. He's a very smart guy. And Anyway, that was one thing he missed, is that his income was too high, and so he didn't get the MIP deduction because he was above the $109,000. And that's the way a lot of people find themselves. If if you've got enough itemized deductions that are over $25,100, that means you've got a really big mortgage probably, where you're paying a lot of tithing or something into a church, or you get a lot of taxes and stuff. And people that are in that bracket usually make more money than $109,000. So very few people get this deduction. Single phases out at $50,000 AGI and ends at $54,500. So I should say it starts phasing out at $50,000 and ends at $54,500. But this is the way this deduction works. So if you do have a house, if you got a mortgage on it and you're paying MIP, you can look into this and see if you get the deduction. The problem is, the number of taking the taxpayers that are able to take the deduction is pretty small. And then the deduction itself is very small. You're not talking a lot of money here on this deduction. So if it were to go away, who cares? That's my thought about it anyway. I mean, you might care. Some of you out there might care. It might be a big thing for you, but I just don't like it. So the deduction was extended to 2021, but it's not yet permanent part of the tax code. So we don't know if it will be extended again. It has been extended every year since 2016. So the likelihood is that it will still be extended, and we've still got that bone out there that Congress has given us. So anyway, hope you've enjoyed this presentation. Like I say, I don't think much of this deduction, but you might. So if you haven't subscribed to the channel, go ahead and hit the subscription button. We'd like to have you as a subscriber, and if you like the video, hit the like button. It's good to be with you, and I'll be back with you probably 7 to 10 days, I would think. So thanks for viewing.